Scott, I don't think we've turned a corner. So coming into the summer, we thought you'd have a lot of volatility. What we told clients is you're going to have some face-ripping rallies, and then you're just going to have some soul-crushing sell-offs. Right now, we're having that rally. Once we get through earnings season, the macro takes over, and we start to get worried about things. At the end of the day, until we see the Fed toggle down or the market believes the Fed's going to toggle down, it's going to be very hard to sustain any rally. So it's good for now, but don't get comfortable.
Yeah, I hear you on that. I do feel like, though, this rally has pushed you a little bit further out on your soul crusher call, if you will, that maybe you thought it was going to come a little bit sooner, and now you're willing to say, well, maybe it's going to wait until the end of the summer.
Yeah, I think that's right. So what's happened is you've had the curve invert. I think all roads lead back to CPI. If you look at CPI on the 13th, what happened? The curve inverted. That's when the back end, or when rates started to go lower. That's when demand destruction, when the market got really comfortable that we're going into recession, demand destruction is going to occur. But importantly, Fed fund expectations peaked and came down. So that's helping things out in the short term. But at the end of the day, we still have to deal with a slowdown. We still have to deal with the macro, and things aren't set yet. We don't know what the Fed's going to say. There's a lot of volatility. And until we know that the Fed is going from 75 to 50 to 25, or it's going 75 and pausing, it's just tough to get excited about the market longer term.
But if I'm on borrowed time, but in fact I do have more time, where do I want to be to try and make some money in that period? Yep.
So I was listening to the prior guests, and we're also in the value camp. In the growth camp, right? We went from cyclicals to value, and value to more of a growth camp. But at the end of the day, growth has run. If you're looking for a short-term trade, a lot of those cyclicals are kind of bombed out. They look oversold. You might get a bounce in earnings in that cyclical space, but that's just a trade, right? Longer term, we want some of these growth companies or former secular growth companies that are trading at a reasonable price. Scott, one thing that people don't realize is 3/4 of the FANG have representation in the Russell 1000 value index. Right? Many of these companies are trading at reasonable valuations. We think longer term, you can make a portfolio, you can make some really good core positions out of this, but they have run, and tactically, this is not the spot to do it.